Well, welcome everyone to Steve Savant's Money, the name of the game. I'm your host, Steve Savant, syndicated financial columnist and money color commentator. On today's show, comparing contracts that could yield significant savings. Part 3 of our series on most policy reviews in money saved with nationally recognized policy review expert, Bob Senske. Welcome to our third segment, Bob.
Thanks for having me. Good to be here.
Bob, now we've touched on this earlier, but I want to kind of go through this because when I came into the business, which was a long time ago, we were on the 1958 CSO. Now, what's remarkable is the endowment or maturity dates were like age 90, 95. The Social Security system is built on the 1941 CSO. We have plenty of money in Social Security if you would just die according to the 1941 CSO tables. We have plenty of money. Then we had a major shift, and I mean major, and we moved to the 1980s, and all of a sudden we're talking about life insurance at age 100.
Yes.
I mean, that's bizarre to me. Then in year 2001, we have the newest update to CSO, the Commissioner Standard Operational Table. All of a sudden, we're talking about endowment dates and maturity dates out to 120. There are carriers, ladies and gentlemen, that are actually illustrating in their proposals to you all the way out to 130. I mean, what's happening? The longer we stretch the timeline, what happens to the premium, Bob?
It goes down. And you're bringing up a great point because you're talking about new policies, and where this is relevant to existing policyholders is that fact makes your older policy look like it's wading through a swamp. It's a lot more expensive and easier to beat. And again, if you're healthy, this is a no-brainer to review your policy because you're probably paying too much.
I think that when you're looking at any policy review, whether it's property casualty, whether it's life insurance, you need to just do the annual review. You need to do it.
Yes.
And what Bob does is he focuses on this because it's the most neglected policy review in the United States. And most people, registered reps, are still learning how to do this, so they're probably not offering their service. That's why Bob's here to talk about these, because this is really important. Health classifications. Look, when I got into this business, you were either a smoker or a non-smoker. That was it. There wasn't all this parsing of different levels. Think about this, ladies and gentlemen. Right now, if I look at your blood and your urine analysis from an underwriting point of view, I could put you at super preferred, preferred plus, preferred non-smoke, standard plus, standard. That's 5 different classifications. In the old days, it was standard or non-smoker or smoker.
Yes.
That was it. The difference between first place and 5th place, what I just described, could be 25%.
Absolutely.
I mean, you're talking about discounts. And how benevolent is underwriting today versus the underwriting of yesterday?
Well, because we're finding cures to diseases. Carriers are developing personalities now for specific diseases. And I learn something new every day. And these are all brand name carriers, people. These are companies that advertise during the Super Bowl. One carrier is very well known for being a little more lenient underwriting with cancer survivors. Mm-hmm. This one particular carrier, again, a nationally known name brand, will allow you, they'll give you a year, and if you come clean on nicotine, assuming that a cigarette smoker can't stay off it, and if you come clean a year later, they will revert you back to non-smoker rates. Huge savings. And that wasn't possible 20 years ago.
No, this is really significant because they've changed the planet on how they look at you.
Yes.
And this is a flip. Let me flip it the other way. We usually talk about people having problems in their health and why we're being more benevolent, and that's a good thing.
Yes.
But what about the people that are out there that are, I mean, runners, high-end diet? They watch their P's and Q's. They are really living a healthy lifestyle.
Yes.
This is a chance for you to go from what I call mundane pricing to excellent pricing. So even if you say, well, Steve, I'm really a healthy person, actually that could benefit you because the higher up the food chain we go, the lower the premium is. So if you could become super preferred.
Yes.
I mean, that's what you're talking about, saving serious money.
Yeah, they're adding more bands into that, just that, like you said before, smoker, non-smoker, where there's even more significant savings. If you're really healthy and you know you are, you're crazy not to review your policy. Again, it costs less today to insure a man of 65 than it did 25 years ago. How can that be? Well, again, we're solving diseases, longevity's happening, manageable diseases. Now, the carriers that specialize in that, you're going to get a better rate. This is another reason why you should review your policy.
And when you think about it, we're in the middle of the greatest mortality revolution mankind's ever seen on the recorded earth. So these things are impacting pensions, they're impacting annuity payments, they're impacting life insurance. They just are. One of the other areas, and this used to be almost a death knell, tobacco users. Now, when I first came in here, we were just talking about if you used any tobacco, you are a smoking cigarette smoker. They didn't care if it was pipe, chew, snuff, they just said any tobacco that you're using, right? You're a non-smoker. Now they've parsed this out to what is your tobacco use? So I have tobacco in the big general category, and I have these subcategories now.
Yeah, absolutely. And one of them, I learned this recently, marijuana smokers who don't, now it's being legalized in a couple of states. Regardless of what you think about it, carriers are starting to acknowledge it. We had one customer who got a standard rating, admitted on their application, you're supposed to tell the truth, that they had never smoked nicotine, and marijuana doesn't have nicotine in it, but that they were insurable, and was fairly surprised to see that. So, and then another thing, when you get to the end, when you get to the end of the year, carriers are trying to close business. And so sometimes you're going to start seeing more lenient underwriting near the end of the year. And you may think that you're super healthy, but the carriers have a hand in wanting to get you through underwriting. And that's another thing that somebody who's reviewing your policy should know. And if it's just sitting there collecting dust, you're just pouring money down the drain.
So think about it, really, there's some very benevolent underwriters. I'm thinking of one carrier on the East Coast that if you actually submit to them and you are a smoker, they will give you a year to get off your cigarettes. They'll give you 3 years, right? They'll give you 3 years to actually get away from nicotine. You'll have to take a test, but they'll give you the non-smoker rate for the next 3 years.
Yes.
See, to me, that is really what I call some lateral pivoting on the carrier's point. And so it doesn't matter if it's cigar, snuff, I just think of snuff, pipe. All these are now being treated differently, and depending upon the usage. Hey, the guy has a cigar once in a while, he's on the golf course. Yeah. That's not going to be a deal killer anymore.
Exactly.
We were talking earlier in the segment about policy crediting rates. If I have a cash value policy, there's 4 types: whole life, participating whole life, universal life, index universal life, and variable universal life. I don't want to get into why each one works, but they each have different crediting types of policies. We could be doing indexing. We could be doing sub-accounts like mutual funds. We could be doing interest rates with UL or participating whole life that uses a combination of dividend performance and savings from the company to declare a dividend every year. Those 4 are all different, but they all are in one genre. If I just went to whole life as an example, the differences between first place and 10th place are like day and night.
Yes.
So you could be in one that you got cash there, but it's a performance issue. It's a crediting issue. It's not doing well.
Right. And, carriers really can be underhanded in this area because they'll have 2 crediting rates. They'll have the guaranteed rate and the current rate. And there could be a 3 or 4 point spread on that. The carrier will often, if they have a reputation for not giving that current rate, or they'll offset the guaranteed rate by increasing expenses. And if you read the article, Carriers at Odds Over Price Hikes, and just Google that, advisors and carriers over price hikes, at odds over price hikes, you will see how carriers have been underhanded in this way and how they, after the fact, credit the policy. And it's costing money to consumers, and they're doing it in an underhanded way that's not visible for the consumer to see. And that's what's making advisors upset as well.
Well, think about it. In a policy review, people like to put embedded value on the difference between what the current rate is that they're actually crediting to the policy and the guaranteed rate. Yeah. That spread or that distance, the smaller it is, the more I like it, because that shows that they're trying to keep close to those values. But when you look at a cash value contract, and I don't care which one it is, you're going to look at those numbers from first place to 10th place. It could be 17 to 25%. It just depends, and your age and so forth and your health rating. That is worth looking on a policy review. You may say, I love my contract with cash value, but there could be a better way to play, and you need to consider it.
And you bring up a great point, because performance, I would say 80% of consumers start out when they first purchase their policy with performance because the agent's selling them on the cash buildup. And one reason why at this point right now, 2017, why you should be reviewing that old policy is probably another 80% of today's population, for those same owners, performance is no longer the priority. Now it's going to be preservation, perhaps. And that's why we can use that cash to get you more years and lower your annual premium forever without compromising your coverage.
Don't forget to watch our next segment, Matching Your Health Condition to the Right Insurance Company, Part 4 of our series on most policy reviews end in money saved. And keep in mind, before moving forward with any of the ideas on the show, always check your tax consultant, legal counsel, or your financial advisor. And if you're doing policy review, with Bob Senske. You've been watching Steve Savant's Money, the name of the game.